Hi, everyone, and good evening. My name is Nai Kalima. I'm a PhD candidate here at the UCL, Institute for Innovation and Public Purpose. Tonight, I am honored to be welcoming our distinguished guest. We'll be hearing from Damon Silvers, a distinguished visiting professor of practice in labor, markets, and innovation here at the IIPP. And this will be the first of a two-part lecture series in which he will be discussing the 2008 financial crisis. Damon has a wealth of experience, in terms of, he brings a wealth of experience and expertise to his role, drawing from his extensive background in policy development and advocacy. Mr. Silvers served as the Director of Policy and Special Counsel for the AFL-CIO, where he played a pivotal role in shaping labor policies and representing the interests of workers, and has been instrumental in championing labor rights and advocating for fair working conditions. Also, Professor Silvers, visiting Professor Silvers, also has a wealth of experience, having served in various parts of the U.S. government, and so in terms of having served as the Deputy Chair of the U.S. Congressional Oversight Panel for TARP from 2008 to 2011, and in various government advisory committees, including the U.S. Treasury Department's Financial Research Advisory Committee and the United States Treasury Department's Advisory Committee on Auditing Professionals. Mr. Silvers holds a JD with honors from Harvard Law School, an MBA with high honors from Harvard Business School, and a bachelor's summa cum laude from Harvard College, and has also studied history at the King's College of Cambridge University. So please join me in welcoming Damon Silvers, whose expertise and dedication continue to make a significant impact on labor markets and innovation, for this important discussion for our MPAs. Thank you.
Wonderful. Thank you so much, Nai, for that generous introduction. As Nai said, I'm Damon Silvers. I'm a visiting professor of practice here at University College London's Institute for Innovation and Public Purpose. Today's lecture is really about the foundations, the sort of how, it's sort of a lecture on how we got here. Meaning it's for the general public, but it's particularly for our master's students in public administration here at IIPP, in terms of telling the story of one of the most important events of the 21st century. In my mind, actually, the most important event of the 21st century to date, shaping the environment in which all of you will function as people trying to contribute to solving the world's major policy problems through developing and administering effective democratic administrative states. What this lecture, and I sort of hinted at this, there is an ocean of material about the financial crisis of 2008. There are movies and books and radio series, and there's just an enormous amount of that. All right? This lecture is not based on that ocean. Right? It refers to it, it draws on research others have done, but what this lecture is fundamentally based on is the financial crisis of 2008 as I experienced it in real time. As a lawyer for the American trade union movement, trying to figure out what working people's interest was in the midst of a maelstrom, a catastrophe with no real precedent, certainly in my experience. And more importantly, my experience as the deputy chair of the United States Congressional Oversight Panel for TARP, the US bank bailout, and my experience representing the American labor movement in global discussions, particularly with the European labor movements, about the aftermath of the crisis. So, if there are things in this that don't have footnotes, it's most likely because I was there. So let's begin. Well, where's the clicker? The first question I think we might ask, our students might ask, particularly who are busy people, is why revisit the financial crisis? Why have this discussion today? And as I just said, in retrospect, the financial crisis that became visible, it did not begin, but it became visible in 2007 and metastasized in 2008, in retrospect, is, in my view, the critical event of the first quarter of the 21st century. It may be the and I think you could easily say it's the critical event since the fall of the Berlin Wall and the collapse of the Soviet Union. It is a real event, meaning that it's not a myth entirely. It is partly a myth, but it's a real event, something that actually happened in history with real and lasting consequences. And it needs to be understood and kept in mind by what that actually was by anyone seeking to affect the course of human civilization in the years to come. But it's also, the financial crisis of 2008 is the subject matter of myth and narrative. And if you are functioning in public life anywhere in the world, today or in years to come, you will encounter myths and narratives built on, to some degree, the facts of the financial crisis. You will encounter stories told by various interested actors to build political power, to justify the policy stances they took at the time or that they take today, and to define what government should and can be, to seek to discredit government as an actor, to seek to elevate government, to seek to put forward a variety of stories about what the proper relationship is between the economy, the financial markets, and the state. As I opened, I want to make the point here tonight that for students seeking to learn how to build effective, innovative states located in sustainable, productive political economies that serve the public interest, it is indispensable history. It is something you must know about, because if you don't, you will be prey to whatever somebody tells you about it. So let's begin with the deep roots of the financial crisis. And let me also say one other caveat here. You're going to discover this presentation is largely about the United States and to a lesser degree about the United Kingdom. The financial crisis was a global event. To tell the entire story of how it played out around the world in 1 hour is simply impossible. The United States, and to a lesser degree the United Kingdom, were the source of it and the dominant actors in it in terms of national economies, and so I'm going to focus on them. I'm happy to take questions and get into other countries and other aspects, and we'll touch on them some more in the next lecture when we talk about consequences. But for the deep roots of the financial crisis, what I think is indispensable to understand is that its fundamental cause was not financial. It had to do with labor markets. With labor markets and taxes and the structure of the neoliberal political economy that came into being in the late 1970s and was the subject of my lectures last year at this time here at UCL, which you can see online. In the late 1970s, the policy framework in the developed world, and particularly in the English-speaking world, around aggregate demand, around the degree to which the economies have enough people spending enough money to drive supply, essentially, to make the economy function. The policy framework in the English-speaking world and in the multilateral institutions like the IMF and the OECD, where the United States and the United Kingdom wield disproportionate influence, that policy framework shifted dramatically. It reversed. From a post-war framework of encouraging aggregate demand through policies that maintained high wages and kept wages aligned with productivity, which were understood in the post-Great Depression environment to be essential to both economic and social stability, that policy framework flipped to a policy framework designed to suppress wages and effectively to suppress aggregate demand. The result in the United States and in the United Kingdom particularly, over time, over decades that followed this switch in the late 1970s and early 1980s, long-term wage stagnation and sustained pressure on aggregate demand was the consequence. But it wasn't just in the United States and the United Kingdom. This was a global phenomenon, and particularly in developed countries. The graph that you see on the screen is the portion of labor's portion of national income in selected G20 countries estimated by the ILO, the International Labor Organization. And as you can see, starting around 1970, it starts to fall. And it's been falling ever since. Now, part of this story is also a story about trade. and trade imbalances. The trading relationships of the world's developed countries with the world's major developing economies changed during this period, where large developing economies, particularly initially Mexico and later China, became essentially export platforms for developed country consumers. This generated further downward wage pressure in the developed world, but it also generated an imbalance, a trading imbalance between the rapidly developing countries, particularly in Asia, and to some degree in Mexico, but really the place where this really happened was with China, a currency imbalance. China began to accumulate dollars in the late 1990s and really began to accumulate them in the early 2000s because China ran large trade surpluses with the developed world. And China had no intention of converting those dollars to China's currency, the renminbi, because if it did, it would make itself uncompetitive and would kill its industrial strategy of developing through exports. And so the dollars had to be exported somewhere. The Chinese had to get rid of them, had to send them back to the United States. And this situation, which was a consequence of essentially a strategy of wage suppression in the developed world, became a temporary solution to wage suppression. Because when those dollars were recycled back to the developed world, they became available to lend to governments, but critically to lend to consumers, which was a kind of solution to the aggregate demand problem, except it wasn't a very long-lasting one. And so we saw in the developed world, policymakers facing aggregate demand problems turning to what I would call regressive Keynesian solutions, meaning ways of borrowing money to fill the demand gap that did not lead to higher wages, right, or to redistributive tax policy. And so you saw tax cuts for the wealthy pioneered by the Reagan administration in the United States, and you saw a wide range of policies designed to encourage consumers to accumulate debt, to support consumption, to accumulate debt on credit cards, to accumulate debt on car loans, to accumulate debt on student loans, and most of all, to accumulate debt for housing. Where this led ultimately in the financial crisis, in the United States most dramatically, but also in the United Kingdom and in countries in Europe like Spain, was what I called at the time idiot Keynesianism. Now, what is idiot Keynesianism? Idiot Keynesianism is the idea that in order to spur economic growth, you instead of having the state borrow money, which was Keynes's idea, instead of having the state borrow money when there is an imbalance in the economy, instead of having the state do it, which can pay it back. The state has a huge capacity to pay money back. Instead, you ask poor people to borrow money, or you encourage poor people to borrow money, and thus to increase consumption. The problem with asking poor people to borrow money is they can't pay it back, right? And that is in a fundamental way the roots of the financial crisis. Now, none of that would have happened, though, had not neoliberal policymakers, both those defined as conservative and those defined as on the left or liberal in US terms, had they not succeeded in deregulating the financial sector to facilitate using credit to substitute for wages. In the post-war world inherited financial regulatory structures. This was true across the developed world, but particularly in the United States. Financial regulatory structures that were designed to prevent exactly what happened in 2008 from happening. And the reason why these structures existed was because something similar had happened in 1929. And in the Roosevelt administration in the United States, and to varying degrees across Europe, there had been financial regulatory reforms designed to prevent speculative bubbles and to insulate financial institutions from the consequence of limited speculative bubbles. The key piece of legislation in the United States in this regard was a banking law called the Glass-Steagall Act that separated, in the United States, that separated commercial banks from investment banks. It separated banking activity designed to support the real economy, meaning to support housing and investment in operating businesses, separate that from financing activity associated with financial speculation in securities markets and related spaces like commodities. All right. The Glass-Steagall Act was paired with active regulation in the financial markets, in stocks and bonds and commodities, that limited the amount of money investors could borrow to buy stocks, limited the degree to which you could sell stocks short, betting on stocks going down, and imposed capital requirements across the financial system on anyone engaging in financial intermediation, right? Banks, insurance companies, savings and loans, etc. In the late 1970s, these New Deal rules in the United States were dismantled. And something similar went on in the United Kingdom. I'm not expert in all the details of how the United Kingdom deregulated its financial markets. Some of it is associated with the term the Big Bang. Right? But in the United States, this structure of financial regulation designed to prevent financial bubbles and finance-driven economic collapse were systematically taken apart. The Glass-Steagall Act was repealed by the U.S. Congress in a bill signed by President Clinton on a bipartisan basis. Democrats and Republicans were both involved by a law called Gramm-Leach-Bliley in 1997. Gramm-Leach-Bliley was followed by, at the end of the Clinton administration, a bill called the Commodities Futures Modernization Act, which made clear that the federal government was essentially not going to regulate commodities and was not going to regulate derivatives, financial derivatives, financial contracts that could synthesize, could artificially create any kind of financial transaction. They could synthesize a stock or a bond or an insurance contract, but they were effectively not going to be regulated because of the Commodities Futures Modernization Act. And then finally, in the early 2000s, because of the pressure that the Gramm-Leach-Bliley Act put on traditional stock brokerages, because Gramm-Leach-Bliley created these gigantic universal banks, Citigroup, JP Morgan Chase, Bank of America, the traditional stock brokerages found themselves at a financing disadvantage. And they went to their regulator, the Securities and Exchange Commission, and got the limits on the amount of borrowing they could do essentially removed. So they could lever up to 33-1. These measures then created the space by which it was possible to create a giant financial bubble that crossed between the banking system and the securities markets in the United States. Now, both a consequence and a driver of deregulation across the developed world was in general, the growth of financial services as a share of the economies of the developed world. A trend that was encouraged, pushed by the multilateral institutions, by the World Bank, the IMF, the OECD. All of these institutions argued that it was better. It was better for economic growth, it was better for openness, better for flexibility, if more and more aspects of national economies were financialized, were moved from either institutions like banks or from the government into the financial markets. The provision of retirement, housing, water. You want to know why the Thames Water Company is the way it is? This trend is what produced it. All right? And the UK was the outlier in this. The United States was dramatically financialized, but the UK did it the most. Close to 11% of GDP at the peak in the early 2000s in the United Kingdom was in the financial sector. Extraordinary number. All right, and this was hailed pretty much universally by economists and financial experts worldwide. There were a few people who were uneasy about it, and they were kind of marginalized. but we'll hear about a couple of them in a moment. Now specifically, the great financial innovation, two great financial innovations, I've alluded to one of them already a bit, but two great financial innovations grew out of this period in the late 1990s and early 2000s. One was securitization. Securitization is when you take a collection of loans. It can be done with other instruments, but it's almost always done with loans. You take a collection of loans. It could be a collection of home mortgage loans, a collection of credit card balances, a collection of auto loans. You take a collection of loans and you put it into a trust, and then you sell shares in the trust to investors, to public investors. There are different ways of doing securitizations, but financial market operatives found that the most effective way to do them was by seniority. So there would be tranches of the securitizations that would be entitled to be paid first. So in a pool of home mortgages, some people don't pay their mortgages, right? As the money comes in a securitization, the people holding the senior tranches of the securitization get paid first, and the people holding the junior ones get paid last. If everybody pays their home mortgages in a given pool, everybody gets paid. If some people don't, the people who are most junior don't get paid. Right? Things have to go very badly before the most senior people don't get paid. That's a securitization. Right? Now, the process of securitization meant that you could have institutions that originated loans, that made loans to consumers, but they actually didn't hold the loans. And that meant that the people making the loans were being paid fees to make the loans. Didn't have to think too hard about whether or not the loans would actually be paid back, because somebody else would have to worry about that. They were just getting paid for the flow. Now, if you start thinking about all the implications of that, you'll realize it's a setup for a bubble. Right? It's a setup for a bubble. Right? And it's particularly a setup for the bubble if nobody's watching. The second thing that happened, the second big innovation that happened, was the growth of derivatives, of swaps markets. As I said a moment or two ago, the idea of a derivative is that two parties, often two banks or two large businesses, make a contract with each other to pay each other sums of money that are driven by some external thing. That, if you think about it for a moment, that is a completely flexible thing. You can turn a derivative economically into anything. For example, I can pay you based on the price of the stock of Amazon. And you can pay me based on the risk-free rate, risk-free interest rate. If we do that, you and I have a deal like that, assuming we honor the deal, don't go bankrupt, right? Then you have essentially bought a share of stock in Amazon, and I have essentially bought a treasury bond, even though none of us have done anything with Amazon or the treasury. We could also have an insurance contract. I could agree to pay you if your house burns down. You could agree to pay me the risk-free rate. That's a house insurance contract with no insurance company. How do I know that you'll actually pay me if my house burns down? How do I know you actually have the money to pay? Who knows? Right? Or what if we have that same arrangement, but it's not my house, it's one of your houses? Kind of a setup for me to burn your house down, isn't it? Which is why that type of insurance, naked insurance, has been illegal for hundreds of years. But all of a sudden, with the rise of the derivatives contracts, and in the United States with the Commodities Futures Modernization Act, a type of insurance that was illegal as being void for public policy reasons had suddenly become legal again. Now, you can see here the growth of securitization in the United States during the period just before the financial crisis. Securitization is central to why the financial crisis happens. Okay? Now, what essentially happened starting in the early 2000s was, in a slow US economy, In a slow U.S. economy, the Federal Reserve both cuts interest rates and decides not to regulate banks' operations in the housing market, and particularly not their sale of subprime mortgages. Right? And what is a subprime mortgage? Move on here. Oops. Subprime loan is a loan offered to borrowers with bad credit or no down payment, no money down. Right. Subprime loans, in the United States, and by the way, I believe in the United Kingdom, there's essentially something called a prime loan. It has certain characteristics. It's considered very secure, stable. It's usually no more than 80% loan to value. The borrower has good credit rating. Right? It's a standard loan. The subprime loan is kind of the bargain basement of loans. Subprime loans' terms were onerous and manipulative. The worst subprime loans had initially low interest rates, 2%, 3%, but then in 2 years, they would turn into 30% loans. Subprime loans were pushed onto communities that had been the victims, in the United States, that had been the victims of long-term redlining, racially based denial of conventional credit. Right? Redlining was literally what banks used to do in the 60s and 70s. They would draw lines through neighborhoods where African Americans or Latinos lived, and the bank officers would be told, you don't loan money there. Into those credit-deprived communities in the 1990s, salespeople for somewhat disreputable loan companies would come and offer people subprime loans, both to buy houses, but more importantly, they would offer families with multi-generational histories of home ownership subprime loans as cash. Right? Grandma, you've owned this house for 100 years. How would you like some cash? You can keep your house, you can have this cash. Oh, by the way, the interest rate is 18%. Maybe not mentioned to grandma very loudly. Now, where did the money come from to do that? These fly-by-night companies were financed. Who financed them? The country's biggest banks, who then told regulators, we're not doing subprime loans. These other disreputable people are doing them. But whose money are they doing them with? Now, how did that work? How was that able to function? Securitization. The loans that were pushed by the fly-by-night operators into poor communities were then packaged into securities and sold by the banks in their underwriting function because of Glass-Steagall repeal. So now the banks were in the bond selling business, was packaged and sold to the public. But the big banks made money at every stage, but they thought they had no risk. We'll come back to that. Subprime lending became a significant problem from a kind of civil rights and consumer perspective in the United States in the 1990s. But during the Clinton administration, it was somewhat reined in by regulators. You can see the growth in subprime lending in the mid-90s. It doesn't get to a level where it threatens the economy. But subprime loans only worked as long as housing prices kept rising, allowing them to be refinanced when their interest rates blew up, or allowing homeowners to sell their homes, to flip their homes. Now, in Europe, in the UK, Ireland, and Spain, similar housing bubbles developed during this period, backed by securitized mortgage lending. This type of lending was not generally subprime, although in the United Kingdom, a huge number of interest-only loans were made, which bankers were suspicious of. And that suspicion turned out to be very costly. The bubble in housing lending in the United Kingdom involved both establishment financial institutions like the Royal Bank of Scotland and kind of old-fashioned, traditional kind of building and loan companies, more regionally based, like Northern Rock in Newcastle. What turned out to be the key problem in the UK was not that the loans themselves were completely unpayable, but that the loans were being funded by very short-term money coming into very rapidly growing banks, which meant that the banks were totally vulnerable to a collapse of confidence in short-term lending markets, as opposed to, say, banks that are funded by deposits. When a bank is funded by deposits, as long as customers don't think that the bank is going to collapse, as long as they feel that the government has the bank's back, so to speak, on their deposits, the bank's funding source is secure. But in this period of financialization, major banks shifted their funding source to very short-term money. And so a housing bubble was developing in the United Kingdom, Ireland, and Spain. At the same time, another kind of problem was developing in Europe, which you've probably heard a lot about, the sovereign debt and credit imbalance in Europe problem. The low interest environment that fundamentally had its roots in the desire of the US Federal Reserve under Alan Greenspan to boost the economy under President George Bush, that low interest rate environment and the structural problems within the EU, which were very similar to those between the US and China, in that Germany ran a huge trade surplus with Southern Europe during this period. These two phenomena led to large-scale sovereign borrowing by Southern European countries. By the way, from the German perspective, the Southern European countries really had to borrow because it was the only way they were going to afford German goods, which the Germans very much wanted them to afford. And who lent them the money? Predominantly German banks. The result was that under a false prosperity within the EU, in which a kind of idiot Keynesianism in a way, right? Instead of an attempt to actually build an integrated European economy with some level of economic fairness between North and South, a deeply unfair economic relationship was perpetuated through debt, at least for a while. And what you see here on this graph is Germany's exploding positive trade balance in euros with Southern Europe. Right? The orange line is the trade imbalance with the rest of Europe. Now we're going to come more to this next week. I'm not going to go through this whole situation today, but I just want you to have it in mind. Now, the bubble begins to burst in 2007 as U.S. property prices, as two things happen. The first is that U.S. property prices start to level off, making refinancing very increasingly difficult. And the second thing that happens is the subprime loans start to fail. And they start to fail in really large numbers. By fail, I mean people don't pay them. They can't pay them. They can't pay the 28% kicker interest rate. And when that starts to happen, and when financial professionals, market actors start to realize that the financial modeling that underlies the securitizations and the financial modeling that underlies the double securitizations. So they weren't satisfied, the Wall Street guys weren't satisfied with simply securitizing mortgages. They took the securities that they issued based on the mortgages and repackaged them and issued further securities. Right? The mathematics behind all of that began to collapse when it turned out that poor people can't pay exploitative mortgages. The first sign that this was going to happen was the failure of two hedge funds associated with the super aggressive US brokerage firm of Bear Stearns. This happened in the spring of 2007. I happened to be with the number 2 man in George Bush's Treasury Department the day that happened. And I said to him, I'm not going to tell you who he was, except I told him he was number 2. I'm not sure he was the number 2. But anyway, it was an important person in the Treasury Department, and I happened to be with him that day, and I asked him, should I be worried about this? Should union pension funds be worried about this? And his answer was, and he was a good guy. This was not, how can I put this? This was in good faith. Right? He said, oh, nothing to worry about there, just incompetent money managers. Now, a few months later, in August 2007, the realization that nobody has any idea what the real risks are in a multi-trillion-dollar intertwined set of markets. Subprime mortgages, mortgage-backed securities, collateralized mortgage obligations, which mean the things built on top of the mortgage-backed securities, the stocks and the bonds of the world's major banks, the short-term debt of the world's major banks, Nobody really has any idea what the risks are underlying these instruments, including many instruments that had previously been thought to be risk-free, causes a liquidity crisis in August 2007. A little tip, really bad things often happen in financial markets in August because a lot of people aren't around and it decreases the general liquidity and trading capacity, and ugly things surface. It's sort of like when the water comes out of the bay, you know, in low tide, you see a lot of ugly things. Well, August tends to produce this. And in August 2007, it produced a global liquidity crisis for a brief period of time. And an example of this is this picture. This is in the Brazilian stock market during that period. There's one guy who wants to buy, and he's surrounded by hundreds of people who want to sell. This was a very, very scary moment. And when I ran into the individual who said nothing to worry about in September, when I came back from vacation and I saw him, I could see the fear in his eyes. September 2007 is when it became clear something really, really bad was going to happen. And the Treasury Department and the chief bank regulator, the person in charge of making sure that people's deposits got paid if there was a banking crisis, Sheila Bair, both started telling Congress in the fall of 2007 in the United States, there's going to be something very bad is going to happen. We're going to have at least 1 million home foreclosures, which at the time was a huge number. There'd never been anything like that since the Great Depression. But please remember that number, 1 million. Before the end of this lecture, you'll have something to compare it to. It's going to be bad. In the UK, remember what I said about how UK banks were financed. In the UK, that brief liquidity crisis in August of 2007 lasted a little bit longer, and it was bad enough to bankrupt Northern Rock. Northern Rock fails in September of 2007 and is taken over by the Labor government run at that time by Gordon Brown, which is really the signal in this country that we are in for a rough time. Starting in the spring of 2008, more major U.S. financial institutions start to fail. The Bear Stearns, the stock brokerage that funded the 2 hedge funds that failed in 2007, Bear Stearns fails and is rescued by the Treasury Department and the Federal Reserve because, and they said this, they had no idea what would happen if they let it fail. There was no formal regulatory structure for rescuing a stock brokerage, but they did it anyway. Major U.S. banks and savings and loans who were big in the subprime market, Countrywide, IndyMac, Washington Mutual, all fail and are sold to bigger banks, which starts a pattern that lasts throughout the crisis. Failing medium-sized institutions are then bought by big institutions. What happens when big institutions fail, we'll come into in a minute. And of course, in 2007, housing prices peak and start to fall, putting more and more and more pressure on this entire system, which is already broken before they start to fall. Oops. Armageddon. Armageddon is what comes next. Total disaster. I love this picture of Hank Paulson. This is a picture of the man who was the Treasury Secretary of the United States during this period. I counted him as a friend. I hope I still count him as a friend. He worked for George Bush, whom I don't count as a friend. He was the former CEO of Goldman Sachs. And in my view, he played a really honorable role in this story, even though I deeply disagreed with him about many policy judgments. But this photo gives you kind of a flavor of what it was like to be Hank Paulson in the fall of 2008. In 2 weeks, in September of 2008, 5 of the United States' biggest and oldest financial institutions failed. Lehman Brothers, AIG, the country's biggest insurance company, Merrill Lynch, the company's biggest stock brokerage, all failed on one day, September 15th, 2008. Fannie Mae and Freddie Mac, two private institutions that had origins as government-sponsored bodies that did prime mortgage lending, failed later that month. The United States government had no had no program to manage the failures of these institutions. And and so what happened was that Lehman Brothers was a stock brokerage. Bear Stearns had been a stock brokerage. Bear Stearns had been bailed out there was no insurance fund, there was no policy anywhere. In my view, Lehman Brothers was consciously allowed to fail on the theory that the incentives that were being created here by rescuing stock brokerages over and over again were terrible for the economy, that they were essentially incentivizing failure. It turned out that Lehman Brothers, afterwards, everyone involved denied that they let it fail. They just said, well, we didn't have the power to rescue it. Letting Lehman Brothers fail, in my opinion, was a well-intentioned mistake. It turned out that Lehman Brothers' position in global money markets, in derivatives markets, was so important that when it failed and there was no rescue, the markets panicked. Merrill Lynch was sold to Bank of America. Merrill Lynch was the United States' largest stock brokerage. It went bankrupt suddenly and was sold to Bank of America, protecting the holdings of Merrill Lynch's customers. Fannie and Freddie Mac were nationalized because they had to be, because the entire mortgage market of the United States would have collapsed. The federal government took 80% of Fannie Mae and 80% of Freddie Mac. AIG was nationalized. There was no legal framework for doing it, but they did it anyway. And I'm going to come to that in detail because it's so telling about what happened here. In response to the failure of these 5 institutions and the perception in the markets that literally anything could fail at any time at this point, that there was no safety anywhere in the private financial system. And not only that, but there was a very strong perception on the part of financial managers in big banks that they had no idea how much cash their company would need the next day or even the next hour. And if you don't know how much cash you're going to need in the next hour, you're not going to give anybody any cash. So the entire global financial system of short-term credit, the grease on which the global economy moves, disappeared. It just wasn't there. In response, equity markets, stock markets go into free fall. The U.S. stock, all over the world this happened. It was probably most severe in the United States. The United States stock market was losing 3, 4, 5% a day. A day. Well, when this happened, I was at a union meeting in Stockholm, and I called the president of the AFL-CIO, who said to me, "What in the world is happening?" And I said to him, "I think I know what's happening, but if it keeps going for another week, we won't have any pension funds at all." What we looked to at that moment, when that happened, was the United Kingdom. At that moment, the person who took leadership, and it's sort of forgotten, is Gordon Brown. Gordon Brown injected £50 billion of UK public money into the United Kingdom's banks as equity. It was called by some people partial nationalization. He bought stock in banks with public money. And by doing so, he signaled that the British government and the Bank of England was going to stand behind the British banking system, that they were not going to be allowed to go bankrupt. While this is going on, the Congress of the Bush administration, led by this man, George Bush was remarkably silent during this period. Dick Cheney, who was vice president, was actively trying to block action. Hank Paulson, the Treasury Secretary, went to Congress and begged. Literally, I couldn't find a photo of this, but I remembered this picture of Hank Paulson literally on his knees before Republican leadership in Congress, begging them to act. He asked for $800 billion, the largest amount ever deployed by the United States government for any purpose other than war, other than world war, to rescue the financial system. The banks wanted that money to be spent to buy the mortgage-backed securities that they held at par, at face value, when they were worth a half or a third or nothing. The law read like it was going to be used, that the money was going to be used to buy those securities, but as the process of passing the law went forward, Congress became more and more nervous about that kind of bailout. And so it was really unclear what the money was going to be used for. It took several weeks to pass the bill, during which the stock market kept falling and credit dried up in the economy. But the bill does pass. And when the bill passes, the American labor movement, not that anyone was really listening to us, but the American labor movement wrote to Hank Paulson and said, do like Gordon Brown did. Put equity into the banks. Don't buy the garbage back for real money. Put equity into the banks as a first step toward restructuring them. Now let's talk for a minute about AIG. AIG is the first true private sector bailout in the US part of the global financial crisis, in the sense that, I mean, Bear Stearns was sort of, but Bear Stearns was kind of an emergency in which nobody quite knew what to do. AIG is a fascinating case of why things kind of went so bad. So AIG was an enormous insurance company with, I can't remember how many hundreds of billions of dollars in assets, global businesses, dominant place in many US insurance markets. But over on the side, where nobody had really noticed, unless you were a derivatives trader, over on the side, AIG was operating what they thought was a very lucrative derivatives trading desk in London that was regulated not by the insurance regulators, but by the savings and loan regulator, the OTS, which doesn't exist anymore because of what happened here, which knew nothing about derivatives and had no capacity to regulate AIG and didn't have anybody in London. And AIG was essentially running a bookie shop. You could go to AIG in London and place a bet for anything. And in particular, what you could place a bet on was that your portfolio of mortgage-backed securities wouldn't go bad. They were selling insurance on mortgage-backed securities. And lo and behold, who shows up to buy insurance on their mortgage-backed securities but Goldman Sachs with a huge bet. Huge bet. Hundreds of millions of dollars. I'm sorry, it's a different level. It's in the billions. It's a huge, they place a huge bet they buy a huge insurance contract in the form of a derivative swap from AIG. Now the way that these derivatives work is the counterparties post collateral. They give you, I give you money to the extent that the contract is running against me. And then you hold the money, right, to ensure that I come up with, I pay my end, right? Now the contract is running against, so Goldman Sachs posts collateral with AIG at the beginning of the contract. Their collateral covers AIG's, their collateral is basically collateral against the movement of interest rates, but they post collateral. You're supposed to put the collateral in risk-free instruments because you might have to give it back. AIG didn't do that. They put the collateral into mortgage-backed securities. So what happens is AIG's obligation to pay Goldman Sachs goes through the roof. The value of Goldman Sachs securities goes down to something like 50 cents on the dollar. Meanwhile, the collateral they're holding, that collapses too. So AIG now owes Goldman both the insurance payout and collateral they don't have. By September 15th, 2008, AIG has an $80 billion hole. Now, AIG had other problems in addition to this swap, but this swap was the fundamental thing. $80 billion. So there was a precedent for this. The precedent was long-term capital management during the Asian financial crisis, a hedge fund that had failed, that had borrowed money from every bank in New York, and then had executed a very complex trading strategy designed by Nobel Prize winners that was fatally flawed. They went bankrupt. They threatened the solvency of the entire US banking system. The Federal Reserve called, under a man named Bill McDonough, who was an old school kind of guy, the Federal Reserve called in all the banks that had lent to this fund and said, fellas, you're going to lend them more. You're going to lend them enough money to unwind this trade, right? We're going to stand behind you a little bit, but you're going to take first dollar risk. You're going to lend more money. You caused this problem. You're going to put the liquidity in to fix it. And in order to make, Bill McDonough being the kind of guy he was, in order to make the point, he had the door locked and put U.S. Marshals with guns behind it. So there was a precedent for how to deal with this kind of situation because Goldman and J.P. Morgan, Goldman and J.P. Morgan were the banks during this monster crisis that had the most liquidity. They had big books of trades with AIG. If AIG went down, they were going with it. And so they were brought to the Federal Reserve Bank of New York by Timothy Geithner, the president of the Federal Reserve Bank of New York, who'd been a former Clinton Treasury official. And Geithner told them, fund the bailout. That was the day that the entire financial system went down, and nobody had any liquidity. By the end of the day, J.P. Morgan and Goldman said to Tim, or actually one of Tim's lawyers, they said, sorry, we're not going to do it. We're not going to fund the bailout. We can't do it. Sorry. And they went home. Next morning, Tuesday morning, the Federal Reserve Bank of New York called the Federal Reserve in Washington. Tim Geithner spoke to Ben Bernanke. The Federal Reserve came up with the $80 billion in public money, more or less. The Fed is kind of quasi-public. $80 billion that stabilized AIG. The Federal Reserve System took an 80% interest in AIG. Goldman Sachs's derivative remained good insurance for Goldman Sachs. Some people then accused the Fed of having rescued Goldman Sachs. Goldman Sachs said, oh no, it's not true. We had double protection. We bought another insurance policy from another bank that's not bankrupt. They didn't rescue us. Later, it turned out that the way that they rescued Goldman Sachs was that what they did was they waited until the TARP money was in place, and then the Treasury bought the underlying securities that were insured by AIG from Goldman Sachs at par. 100 cents on the dollar for securities that at that moment were worth 60 cents on the dollar. Now this story, in which public money at every turn is used to rescue private failure, and in which efforts to hold private parties like Goldman and J.P. Morgan accountable for the systemic crisis they had contributed to, where those efforts are rebuffed by private parties with no consequences. These are the foundations of the long-term damage to global democracy that was done by the financial crisis, which I'm going to come to in great detail in my next lecture. I asked someone deeply involved in this during my service on the Congressional Oversight panel. I asked somebody deeply involved in this, you ever think maybe you should have insisted with Jamie Dimon and Lloyd Blankfein at Goldman and Morgan? You ever think maybe you should have insisted? And that person said to me, and I value this answer, that person said, I think about that all the time. Now, just a few words about Fannie and Freddie Mac. Fannie and Freddie Mac were two organizations founded in the New Deal era to securitize predominantly prime mortgages. Right? To take big pools of mortgages and turn them into 30-year fixed-rate mortgages, affordable, fair-term mortgages, turn them into securities to enable the long interest rate risk associated with very long-term money, get it off the balance sheets of the banks. They're critical to the United States' whole system of home ownership, right, in the way it's done in the United States. They were originally government-owned corporations. They were fully privatized under Bill Clinton, which led to a lot of problems. But everyone who bought the securities they issued assumed that those securities had some level of government backing, even though they were privatized. Fannie and Freddie, despite what you will be told if you ever get into a conversation about this with people who have a more kind of market fundamentalist perspective, you will be told that Fannie and Freddie caused the financial crisis. It's simply not true. The Federal Reserve looked into this great detail. There are papers about it. It's not true. Fannie and Freddie never securitized subprime mortgages in meaningful amounts. But what they did do was, after the subprime bubble was in full motion, because they had been privatized, and this is a very IIPP point here, because they had been privatized, they were under equity market pressure to maximize returns to shareholders, and they bought the garbage the banks were issuing. They didn't actually securitize or make subprime loans. They bought the garbage other people were making. And so, as a result, they went bankrupt because the value of those loans collapsed. Fannie and Freddie are not the central causes of the crisis. Their involvement in the crisis, as I just described, had nothing to do with housing policy. They were not told to make subprime loans or to finance subprime loans. They did it on their own for financial reasons. And this has nothing to do with anyone's racial justice agenda. Nothing. But you will be told otherwise. All you have to do is get onto social media, and you will be told otherwise. And you'll also be told otherwise by reputable people. A University of Chicago law professor told me this not about 2 months ago. Right? Not aware that there's actually data, and the data is totally different. And this is the chart of their subprime loan purchases. You can see it's all in 2004 and 2005. In 2006, they started buying in 2004 in large numbers, after the whole machinery was already in motion. Now, in 2008, as I said, in September 2008, after the Armageddon I described, the Troubled Asset Repurchase Program was created by the US Congress. Instead of buying junk securities at full price, which is what the banks wanted, Hank Paulson, to his great credit, essentially followed Gordon Brown and did equity investments in US banks. He bought preferred stock in the United States' 10 largest banks. He forced the two largest remaining stock brokerages, Goldman Sachs and Morgan Stanley, to turn themselves into banks. And he bought stock in them. Paulson asserted when he did this, and he had complicated reasons for asserting this, he asserted that they were only investing in stable banks, that no bank that was unstable or unhealthy could get money from the federal government. He also said that there was going to be a program for equity investments with TARP money into small banks. And of course, they would have to also prove that they were solvent, that they were stable. It very soon became clear, and some people complained a lot about having to accept TARP money. The big complainer was Jamie Dimon, the CEO of JP Morgan Chase, the country's largest bank. Jamie Dimon said, hey, I didn't have anything to do with this. My bank's completely solvent. I know I shouldn't have to take government money. It makes it look like I'm a deadbeat. Now, Paulson needed everyone to take the money. So Jamie took the money. He just complained. But you got to remember what I just said about AIG. Had the other banks gone down, they would certainly have taken Chase with them. And particularly had AIG gone down because of Chase's exposure in the derivatives markets. Even more troubling, it soon became clear that two of the country's largest banks, Citigroup and Bank of America, were actually insolvent. Now, what does it mean to be insolvent? What it means is they ran out of cash. Just before Thanksgiving, in late November of 2008, Citigroup and Citigroup's sort of patron, Clinton's Treasury Secretary Bob Rubin, called Hank Paulson's office and said, we are going to be out of cash on Tuesday. They called on the Friday before Thanksgiving. I remember I was in the Treasury Department. They neglected to mention to us, who were the overseers of the program, that this was happening. The call came in and they were told, Tuesday we are out of cash. Citigroup. So they injected more cash into Citigroup, all the while claiming that Citigroup was solvent. There was a special program created just for Citigroup, and they put more money in. A key decision maker during this period, in a private conversation, said to me, when I objected, I said, I remember I was the deputy chair of the Congressional Oversight panel overseeing this program, and I said to this key decision maker, I said, you're telling the American public that you're only giving money to stable banks, and this bank is running out of cash, and you're giving them money. And this person said to me, without confidence, no bank is solvent. By which this person meant solvency is made up. Solvency is made up. There's no such thing. Solvency is because people believe it to be so. And if we say it's so, they'll believe it, and they'll be solvent. After these initial rounds of TARP investments were made, and by the way, the same basic process was repeated with Bank of America just before Barack Obama was inaugurated in January of 2008 and 9. While the Bush administration was still in control of TARP, Bank of America was rescued again, even as they were saying they were only giving money to solvent banks. When all this initial round of investment in the country's major banks was finished, the Congressional Oversight panel that I was the deputy chair of did an independent valuation using a whole ton of academics and a very well-respected firm called Duff & Phelps that just does evaluations. And we found in a 1,000-page report that the investments that were being made in these banks, which the public was being told were being made at par, that the preferred stock that the public was getting in return for the cash was worth what the cash was, that actually the preferred stock was worth about 2/3 of what the cash was. And the rest was a subsidy to the big banks. However, it has to be recognized that despite all of this, TARP achieved during this period its real objective. Its real objective was to restore liquidity to short-term credit markets. And by the end of this period, that had actually happened. You could do business with overnight money, both in the United States and worldwide. Right? It was more expensive than it had been before, but it was coming down. Now, just a word about the Congressional Oversight Panel for TARP. The Congressional Oversight Panel for TARP was essentially an advisory body that we made into much more than an advisory body. It was created by Congress when TARP was passed, along with a special inspector general. He was not advisory. He had the power to indict people. But we were created to address fears of crony capitalism, which I was just discussing, in relation to the TARP. The Oversight Panel had 5 members, which were appointed by congressional leadership, 3 from the majority party, the Democrats at the time, and 2 from the minority party. I was one of the members of this panel. The other member whom you've heard of, probably heard of, is now United States Senator from Massachusetts, Elizabeth Warren, who was then a Harvard law professor. We elected her the first chair of the Oversight Panel. When she became a senator, when she went to work for the White House as part of the Obama administration's financial reform efforts, she was succeeded by Ted Kaufman, who was also a United States Senator and was Joe Biden's successor as Senator from Delaware, and later a key figure in the Biden-Harris transition team. I can't express my admiration for both these people enough. The Oversight Panel for TARP, for those of you who are interested in this subject in a deeper way, is an invaluable source of information about the financial crisis. We held monthly hearings and issued monthly reports every month from 2008 to 2011. Our reports, we had a staff of about 25 people, extremely skilled. Our reports have comprehensive data both on the bank bailout, state of the mortgage markets, the state of the financial markets. The hearings were held both in Washington and all over the country. The Treasury Secretary, Tim Geithner, was a frequent witness. All of this can be found at this web address, which I'm happy to share with you. But this PowerPoint will be online. This picture, by the way, it's a little blurry. This picture is a picture of Elizabeth Warren with Jon Stewart in the first month or so of the workings of this committee. And Elizabeth is explaining to Jon Stewart what is going on, more or less as I've just been. And Jon Stewart is saying to Elizabeth, you're the first person that I've heard speak about this matter whom I trust. It's a deep, deep moment in American politics. You might say that neoliberal hegemony in American politics died that moment. That moment was when suddenly there was a political force that rejected the idea that private financial interests should run the world. Right there. Now, when I first came on the COP, I was a little nervous, frankly. I felt, despite all the degrees that Nye was talking about, I was a little concerned that I might not know how to solve the global financial crisis. So I called somebody who said to me, well, you should talk to the IMF. And I said, the International Monetary Fund, whose headquarters happens to be down the street from that of the American labor movement. And I thought to myself, well, that's probably a good idea. They must know something about this. So we had lunch in a little Indian restaurant in Georgetown in Washington. And these guys came from the IMF. I don't remember their names, but they were very IMF-y. They were very tall, and they wore these dark blue suits, and they were very blonde. And they were from somewhere in Northern Europe. And they said the following thing to me, which I will never forget. And I was able to write it right down from memory, preparing this lecture 15 years later. They said, all financial crises are the same. They start with overextension of credit, generally in the real estate sector. Policymakers first try to deny there is a crisis. Then they try to prop up the banks. Then they restructure the banks, meaning they put the banks through a bankruptcy proceeding in which the investors in the banks get haircut. We'll come back to that. And then they said this absolutely deadpan. They said the length of time it takes to go through the three steps is the measure of the degree of political corruption in the society at hand. Unfortunately, and we'll come back to this, we never restructured the banks. And you can draw what conclusions you wish from that fact. Now, this is actually the graph of the recovery of the short-term money markets. The TED spread is a measure of risk in overnight money. And as you can see, it went bananas in late 2008, and then it calmed down. The effective shutdown of global credit markets in the fall of 2008 triggered, on top of the underlying problems in the housing market in the United States and the United Kingdom, triggered a dramatic contraction of economic activity. Paul Volcker, the kind of renowned former chair of the Federal Reserve, said at the time that it was a more rapid economic contraction than the Great Depression at its worst. However, as I said earlier, the interventions by central banks and governments to essentially guarantee the solvency of the major banks, to shore up the major banks, led to a gradual revival of short-term credit markets between November 2008 and February 2009. But what these interventions did not do was to address either the underlying problems in the housing markets, the problems in the international trading system I began with, the problems in the labor markets, or most immediately, what to do with the big banks. In particular, what to do with the obviously insolvent Citigroup and Bank of America. As a new president, Barack Obama took office in the United States in January 2009. The question on the table was bailout or restructuring. And there's Barack Obama getting sworn in on a very, very cold winter's day in Washington, D.C. There are two different kinds of bank rescues. There are bailouts and there are restructurings. A bailout is the infusion of both cash and, if necessary, equity. So you can infuse cash by loaning the bank money. Then the bank has to pay you back. Maybe you loan the bank money on very favorable, by you I mean the government. You loan the bank money on very favorable terms, maybe some other terms, but you get them liquidity, cash. Equity is another matter. Equity is you hand them money and say, feel free to lose this money. We'll take the risk. you hand the banks cash and equity. In a bailout, you hand the banks cash and, if necessary, equity at a level that preserves the capital structure of the bank. Now, that's a highly technical term, but what that means is that the bondholders of the bank, the stockholders of the bank, and the executives, who are almost certainly have most of their wealth in the stock of the bank, they are kept safe. Now, the problem with that is it's not how capitalism is supposed to work. Right? If you break a business, you're supposed to pay. Right? But this is a way of making sure that the people who broke the business don't pay. Now, a restructuring is a very different thing. A restructuring means you essentially put the bank through a bankruptcy process. Now, in modern times, this is always done by guaranteeing the parts of the bank that you don't want to run away. So you don't want to have a run on the bank. You don't want the depositors pulling all their money out. So you tell the depositors, you're safe. Your money's guaranteed. You don't want short-term creditors running away. You don't want Northern Rock. So you tell the short-term creditors, your money's guaranteed. But people who put long-term money in the bank, long-term bondholders, stockholders, well, you take your chances. Right? In a bankruptcy or a restructuring, those people take haircuts. Generally, the equity is eliminated, wiped out, gone. Bondholders who thought they had guaranteed principal and interest end up having to accept stock, at least in part, in a restructuring, and end up having to take more risk than they had wanted to. Often that actually turns out great for them, because when things recover, the stock gains in value. But they don't like that. Bondholders do not like that type of restructuring. However, restructurings were the dominant form of bank resolution in the US in the New Deal and throughout the world in succeeding banking crises after the Second World War, up to and including the Swedish crisis in the early 1990s. Why is it? Why is restructuring banks so important? The reason why it's so important is because if you have the flexibility to write down the capital side, the liability side of the balance sheet, then you can write down the asset side. Then you can go to homeowners who have loans they can't pay and say, hey, how about paying 50% of that? And that enables your economy to recover. And at the same time, it enables your bank to recover so the bank can lend more money. Right? The huge problem everybody feared in this process was the zombie bank. The zombie bank is a bank that looks like it's there, but isn't really. It's so weak financially it can't lend, which means homeowners can't buy homes. Small business people can't grow their business. Consumers can't buy cars and refrigerators. The zombie bank was the big fear, and there was a conventional wisdom among people with histories, like my IMF friends, that you restructure banks. You don't bail them out, because when you bail them out, you get a zombie. But it turned out that bailouts were going to be the dominant form of policy response to the 2008 crisis. How did that happen? In the early weeks of the Obama administration in 2009, in January 2009, a number of prominent voices urged President Obama to restructure the big banks, at least Citi and Bank of America, if not the others whom people suspected were also no good, if you properly valued the mortgages. By doing that, you would then be able to restructure the defaulting subprime and underwater home mortgages and save millions of families' homes. And if you did that, you would get a healthy housing market. And if you did that, you would get the banks to lend to small business, which would cause the larger economy to revive. That was the theory. Who believed in that theory? Some people you might have heard of. Joe Stiglitz, shown here in younger days. Paul Krugman, the Nobel Prize-winning economist at the New York Times. Jeffrey Sachs, who has spent a lifetime trying to undo the consequences of advice he gave in Russia, but also has a Nobel Prize. Paul Volcker, the most respected central banker in modern American history. Now, the Krugman, Stiglitz, and Sachs were public about this. Volcker is was a very sharp guy. He's unfortunately died. But that was the advice he gave in private. And, fascinatingly, Hank Paulson's senior aide, a man named Neil Kashkari, who is now president of the Federal Reserve Bank of Minneapolis, is one of the truly principled people in this story, although I had no idea this was true at the time. He was yelling at Paulson, much as I was, you've got to restructure the banks, you've got to restructure the banks. This was also the position that Elizabeth Warren and I took on the Congressional Oversight panel, and is reflected in our reports that she and I signed. We were the only, there were 5 members of the panel. She and I were the only 2 who supported this position clearly. Who was on the other side? Well, the other side of this argument had the advantage of actually being President Obama's senior officials. They were Tim Geithner, over here, whom I talked to you about a few moments ago in the context of AIG, who at this time was the Treasury Secretary of the United States, and the President's chief White House economic advisor, Larry Summers, Harvard professor and sort of public intellectual, and former Treasury Secretary under Bill Clinton. Larry and Tim thought that we should do a bailout followed by close supervision in which the banks were forced to earn back capital. This was the consequence of Tim Geithner's study while he was working for the U.S. State Department in Japan of the prolonged Japanese banking crisis in the 1990s and the Japanese banks becoming zombie banks. And Tim had a theory that you could prevent zombie bankism without restructuring. Now, this theory had an advantage of being popular with the people in New York who he worked with at the Federal Reserve and various other places, because it envisioned a solution that didn't involve wiping out stock or writing down bonds held by a lot of people in the banking industry. Now, I don't think that's why Tim advocated this, but it, shall we say, was an added benefit. Now, despite being advised by the advocates of restructuring that there would be serious economic and social consequences of not restructuring both the banks and the subprime loans, and by that I mean some of these individuals stared Barack Obama in the face and said, "You are going to destroy home ownership among the country's poorest people. That will be the consequence. It may look like you're making a decision. It may look like you are making a decision about bank capitalization, but you're not. You're making a decision about whether home equity built up over generations by the African American and Latino communities in the United States will survive." Despite being told that, President Obama and his team followed Geithner and Summers' advice. And in certain respects, it worked. The use of TARP to rescue the banks without restructuring, together with huge amounts of liquidity injected in both the banking system and the U.S. economy by the Federal Reserve, restored liquidity in the financial system by restoring confidence. Confidence that major banks wouldn't just explode without warning tomorrow morning. To Geithner's credit, Summers was less involved in this. Geithner was deeply involved in it. TARP did ultimately seek and achieve dilution of the equity holders of the banks that had achieved extraordinary assistance, like Citigroup and Bank of America. The bondholders were never touched, but the equity holders were substantially diluted, but they weren't wiped out. And when those banks recovered, the equity holders did actually do pretty well. Nonetheless, they were very significantly diluted, and the Obama administration is very proud of that. And TARP did break even on a cash basis, meaning for every dollar that went out, dollars came back. But it got none of, and this is an IIPP point, the American public got none of the upside commercial investors would have demanded in return for making such a risky set of investments. And this was a direct consequence of the terms of the TARP securities being well below in value what Treasury paid for them. The reason why they were below in value was because they didn't have meaningful upside. And underneath this, the fundamental problem that small banks all over the United States were subjected to real solvency tests, while big banks just got money when they asked for it, corroded the American public's faith in democracy, and in particular, corroded the faith of key elements of America's business class away from the big cities, in the way that our country worked, which, as you might imagine, has had consequences. The financial and legal consequences of the bailout strategy. So those were the successes. What were some of the other consequences? The bailouts gave rise to what they call extend and pretend in bank regulatory language. You try to earn back the bank capital from the bank's customers while carrying assets on bank books at unrealistic values and refusing to negotiate with the people who owe you money that can't pay you. Instead, you seize their homes. And then you pretend that the mortgages that you hold are actually worth what the paper says they're worth, when in fact, there's no chance you'll ever get that money back. This strategy prevented any concessions from being made to homeowners, because if concessions were made to homeowners, the pretend part of the strategy would collapse. The strategy also prevented any serious efforts at legal accountability aimed at bank executives and capital markets participants, even after massive fraud was revealed in U.S. mortgage markets in the robo-signing scandals, which I'll come to in a minute. You couldn't do law enforcement, because if you did law enforcement, you would jeopardize public confidence in the banks. At least that's what people said. Now, by the way, I should say the Obama administration officials involved in law enforcement during this time strenuously deny that that is true. But having discussed this matter in depth with the people who were responsible for that law enforcement, I am convinced it is. The economic and social consequences of having the public recapitalize the banks. Foreclosures. By the end of 2012, 10 million U.S. homes were in some stage of foreclosure or forced sale, affecting approximately 15% of the U.S. population, 40 million people. African American and Latino communities' median household wealth was reduced by 60% from 2005 to 2010 because household wealth in the African American and the Latino community is overwhelmingly in home ownership and not in the stock market or annuities or anything else. White families' median household worth only fell 23%. One of the worst statistics there is about the United States is this one here. This is median household wealth in 2010. $110,000 for the median white family, $7,424 for the median Latino family, $4,955 for the median African American family. Less, as the president of the AFL-CIO said to me when he saw this, he said, that's less than the value of a bad used car. The big banks withdrew substantially from small business lending as part of their de-risking strategy, being pushed by regulators to take risk out of their portfolios. That slowed economic growth. There was a negative feedback loop between underwater residential real estate, meaning homes that were worth less than the loans that had been taken out against them during the bubble when prices were high, and unemployment. So as unemployment grew, housing prices fell, more homes became underwater, people couldn't move because they couldn't sell their homes, so they couldn't get a new job. This led to a conversation that I had in the driveway of the White House, 2010. An Obama administration official said to me, did you see 60 Minutes, the American news show last night? Show about kids doing their homework by flashlight while living in their cars. And I said to that individual, a fine person in many respects, I said to him, aren't we here in the White House? Aren't we supposed to do something about this? By 2011, it is clear that the U.S. and the world economy, the U.S. because of what I just went through, the larger world economy because of austerity policies pursued in the U.K. and in the EU, that we are slipping back into recession after having escaped it, partly due to the stabilization of financial markets and partly due to the Obama administration's fiscal stimulus, the American Relief and Recovery Act. The initial push the world economy gets in 2009 and 2010 begins to be overcome by these dynamics and by austerity. Oops. Now I want to turn to the issue of law enforcement, because again, this contributes to the larger problems next session. Or where were the black Suburbans? I don't know if this means anything to people outside the United States, but when law enforcement raids a financial institution in the United States, they do it in these vehicles called black Suburbans. the giant SUVs made by Chevrolet, they show up and take away all the files. This is how, during the insider trading scandals, all these black Suburbans went down to Wall Street and they took Michael Milken and Ivan Boesky's files away and they walked them out in handcuffs. It was very impressive. It made people feel like maybe rich guys had to obey the law too. None of the major financial executives involved in the financial crisis were criminally prosecuted or the subject of civil securities, accounting, or bank fraud proceedings, either in the US or the UK. By the way, Gordon Brown, to his eternal credit, has said that he thinks now that was a mistake. This, although nobody involved in those decisions in the United States has been so bold as to say so. This was true despite the fact that there were obvious issues in the financial disclosures of the major financial firms, the major banks. How could there not be? They all represented themselves as not only solvent, but financially healthy and profitable in all of their financial filings until suddenly they ran out of cash. That can't be legal. Right? The fact that that happened in that way cannot be legal. People knew and they didn't say. The one exception was a significant Goldman Sachs collateralized debt obligation trade called Abacus that was the subject of an SEC civil investigation in 2010, and Goldman Sachs was found to have violated the securities laws. Why this particular transaction received this particular treatment is one of the mysteries of the financial crisis, but it must be mentioned. In the fall of 2010, it became clear that not only what I just said about disclosure must have happened, but it became clear, factually explicit, that the entire subprime market was riddled with the most obvious fraud, which was that nobody had signed the loans. Tens of thousands, hundreds of thousands of subprime loans had been put on books, entered into deed registries, filed with banking regulators, and the borrowers hadn't signed the loans. The banks and the mortgage companies had left, as we say in the US, left-handed them. They'd signed them for the borrowers. And still nobody went to jail. By the way, a huge effort was made by a number of states' attorneys to try to do something about this last thing in 2010. Eric Schneiderman, the Attorney General of New York, whom I worked for on a volunteer basis, someone you might have heard of named Kamala Harris, who was the Attorney General of California, and most heroically, the man whose memory I try to keep green in this matter, was Beau Biden, Joe Biden's son. He was the most uncompromising, the most aggressive, the most angry, and he died of a brain tumor. Along with all of this, with TARP, with the mortgage crisis, there was a huge central bank intervention by the US Central Bank, by the ECB, by Bank of England, by central banks around the world. Between 2007 and 2009, the US Federal Reserve System made unprecedented amounts of liquidity available to financial markets and institutions. They pushed interest rates to essentially zero. They bought long-term debt securities called quantitative easing to push down long-term rates. They did everything they could possibly think of and more. In my view, this effort was heroic. It was essential to preventing a true Great Depression. And it prevented a much more serious collapse in the housing market. However, because it wasn't paired with sufficiently aggressive regulation and restructuring of the banks, it did tend to push money toward the financial markets and away from things like lending to small business. And that turned out to be very costly, both economically and politically. In conclusion, what I'm telling you is a technical history of the financial crisis, but it's also the story of how the financial crisis morphed into a political crisis. By the fall of 2009, the financial crisis in the United States and the United Kingdom in its pure form, meaning the failure of major financial firms and the freezing up of credit markets, had passed on. It had ended. And in the United States and the United Kingdom and in Europe, there were major legislative reform efforts underway. In the United States, those efforts became the Dodd-Frank Act, which we'll talk about next time. But the economic crisis, not the financial crisis, but the economic crisis was nowhere near over. As I said, as of late 2010, early 2011, it was clear that the US and the world economy was slipping back into recession, fueled by foreclosures, underwater residential real estate, and disastrous austerity policies in the US, the EU, and the UK, which we'll talk about tomorrow, on Tuesday. But most importantly, in retrospect, the political crisis that the financial crisis sparked was just beginning. The crisis of democracy and the reemergence of the authoritarian right on the world stage. The governance and economic crisis of the EU and the associated crisis of Brexit. The crisis of the international institutions of the neoliberal order and of the relationship of countries like Russia and China to that order. And ultimately, the crisis of the political hegemony of neoliberalism, which, as I said, in the United States, that iron grip that neoliberalism had on American politics died when Elizabeth Warren talked to Jon Stewart. These legacies of the financial crisis, economic, social, political, and intellectual, are the subject of next week's lecture. Thank you. Now, Nye has kindly volunteered to manage the questions.
Questions?
And online, obviously.
Yeah. Okay, I'll begin with maybe an initial one to kick us off.
Yeah.
So one of the key players that you brought up during the talk was kind of looking at the role of Tim Geithner throughout.
Yes. Yeah.
Tim Geithner at this time was acting on behalf of the U.S. Treasury Department. However, Tim Geithner had also at one time, I believe from 2001 to 2003, was director at the IMF.
Yes.
And so with respect to kind of the approach that was suggested with the IMF versus what he was recommending when acting on behalf of the Treasury Department, what was going on with that?
Well, I can't. That's a really interesting question, obviously posed by somebody who knows something. So the people that I met with from the IMF were staff people speaking privately. The IMF, and they were describing, I think honestly, the IMF's view of this matter across all countries. But all countries are not equal in this world. And they certainly aren't equal, in my view, at the IMF. Right? Now, that being said, as a board member at the IMF, Tim was entitled to his own opinions. I don't think we're necessarily describing here something really profoundly rotten. I disagree with Tim, right? But the fact that he and the professional financial crisis staff at the IMF might have had different points of view, shall we say, is not entirely surprising.
Other questions?
Sorry, what I can't get my head around is how, in the UK in particular, the banks were ever allowed to lend long-term and finance it by short-term borrowing. To me, that is just so fundamental. Where were the auditors? Where were the finance guys? Like, how did that happen?
Wow. See that, Nye, can I get the mic? I think I need the mic to be able to answer. Oh, I got this thing, right. I don't need the mic, sorry. Very kind of you to observe that. You know, that question haunts this entire story, not just in the United Kingdom, but in every country where the banking system fell apart. In Spain, in Ireland, in Iceland, obviously in the United States and the United Kingdom. And there are examples of countries where this did not happen. One of them is Australia, where the bank regulators maintained a kind of iron grip on these issues of funding asymmetries and risk and so forth. Also in Canada, actually. So what exactly happened? I do not know what exactly happened in the United Kingdom, but I certainly remember the environment around regulatory policy in the UK during that period, which was soft touch. Soft touch. We were told in the United States we needed to weaken our financial regulation, and particularly our accounting regulation, in order to be competitive with the United Kingdom. And I think there's no doubt, looking at what happened in the UK economy, that there was an intentional strategy initiated by Margaret Thatcher, but sort of maintained throughout until 2008, in some respects, I think today, of making the United Kingdom an attractive source for capital through weak regulation and low taxes. Right? During this period, that got to an incredibly destructive point. And there was something deeper underneath it, which was proven simply to be not true. There was a belief that markets regulate themselves. Right? That was what Alan Greenspan, in my neoliberalism lecture I talked about this. Alan Greenspan, who was the head of the Federal Reserve before Ben Bernanke. Ben Bernanke was the head of the Federal Reserve during this period, and he's the guy who pumped liquidity into the economy, right, and deserves great credit for doing it. His predecessor was Alan Greenspan. Alan Greenspan was the person who chose not to regulate subprime. And he got in front of Congress as everything was falling apart, and he said, "I'm sorry, I made a mistake. I was wrong. Markets don't regulate themselves." But I think that belief was very strong in the United Kingdom. And I think that, and again, my lectures last year go into this in some detail. I think there's a profound reckoning that has to be made in this country. In order for this country to prosper, there's a profound reckoning that has to be made sort of intellectually with the idea that this country, that the United Kingdom, can prosper by sourcing bad money, by sourcing people who don't, by bringing into the United Kingdom money from people who don't want to be regulated, don't want to pay their taxes, don't want to be known as even who they are. That's a viable strategy for prosperity. That really has not yet been fully addressed. That was a long, rambling answer, but I hope it was satisfactory.
So a couple of questions. Can you run us through the alternative scenario if there had been a cram down, a restructuring of the banks?
Yes.
How do you think that the events would have, fallen down, and would the political impact have been different? And then the second quick question is, I think there are countries where the decision was never made, and there are zombie banks, like Italy,
Right.
where I guess there was no political or maybe money to do a bailout. Could you perhaps touch upon that?
Sure. Well, counterfactual history is a lot of fun. I think what's important to understand about the question of what would have happened had a different decision been made, which illuminates why it wasn't made, is that Barack Obama was newly inaugurated president. He was facing an economy in free fall. He was the nation's first African-American president. He was someone whose experience in public life prior to becoming president was not as limited as Lincoln's, but somewhat less than some other presidents. He had enormous popularity. Huge hopes were placed in Barack Obama, including by people who voted against him. It was very interesting, the environment just after the election in respect to this. There was this feeling in the United States in the fall of 2008, after Election Day, that turned out we were better than we thought we were. Right? And in the sense that we were capable of electing this really honorable, admirable man to be our president, right? And not an idiot. And we had elected some idiots, to be honest, right? And we weren't as racist as we thought we were. That feeling was very intense in the country. And what those of us who were urging restructuring were urging on Barack Obama. And by the way, he had campaigned for 2 years on the idea of uniting the country. The Bush administration had been very divisive, the Iraq War, Hurricane Katrina. Right? It was like there were no There's no red states and blue states, Barack Obama would say. And so we were asking him to pick a fight. We were asking him to go right against the wealthiest and most powerful people in the country. And I think he had some concern that he might not win. Right? That maybe if all of Wall Street decided that he was a bad guy, maybe America would turn out not to be quite as unracist as America seemed to be, with billions of dollars behind going after him. In a similar situation in the 1930s, Franklin Roosevelt went right at Wall Street with the full power of the United States government. He dismantled banks, he put people in jail, he unleashed other people who were even tougher than he was. And he restructured the banking system to really radically weaken the very institutions that deregulation in the 1990s had radically strengthened. We were asking Barack Obama to do that. It was really explicit that we were. And the question was, would he win? That question must have crossed his mind. And what he said, I happen to know, I wasn't there, but I know that he said this, was he said, and you remember what I talked about this, he said, what we are doing, what my team is doing, is stabilizing the markets. I've got important business to do. I want to pass health care. I want to get the United States out of Iraq. I've got a long list of really important things to do. I need financial stability. As long as these guys deliver financial stability, right, I got to let them do their job. In my opinion, it turned out that, in fact, the most important business he had to do was to hold the financial system accountable in the name of the American people, and that the failure to do that produced a catastrophe. The catastrophe was slow motion, but it's not over. Right? And so the counterfactual, right? The counterfactual is, well, do you think he would have won that fight with the banks or not? Right? If he'd won that fight with the banks, if he'd successfully restructured, in my view, millions of people would not have been thrown out of their homes. The economy would have recovered much faster. The Democrats would have won the 2010 congressional elections. And Barack Obama would now be viewed as the new Franklin Roosevelt. That if he'd lost the fight, then not only would he have lost the 2010 congressional election, but he would have lost the 2012 presidential election. And who knows whom he would have lost it to. Because already by 2010, the political forces that produced Donald Trump were in motion.
Just in your opinion, and maybe it's touching into your next lecture, does this framework that was instituted on the bailouts, did it solve the problem, or is it now like all the institutional, the laws and the policies are coming down now, and are we in risk of another financial crisis, maybe from a different sector, but are we still at risk, or is that somehow capped?
All right. Well, in part, the answer to your question is it's now 2024. These events were in 2008, 2009. We've had some bad episodes, but we have not had nothing like the financial crisis since then. So that suggests, and I will come back to this in detail on Tuesday, because your question is really about the effectiveness of the restructuring of the UK financial regulatory system that was pretty thoroughgoing in the aftermath of these events. The passage of Dodd-Frank in the United States, the creation of international bodies to monitor financial stability, a whole bunch of things happened, right? And we've been through enormous shocks. I mean, the COVID shock could have easily triggered a financial crisis, and we haven't had one. Does it mean the threat of the financial crisis has gone away? I don't think so. And I think the reason why it hasn't gone away is because the underlying drivers in terms of economic inequality and suppressed demand, trade imbalances, and political imbalances, or political corruption, as my friends at the IMF would say, These things are still with us, right? But the regulatory structures are much stronger, and more importantly, I think, the ideological factors that produce the kind of inexplicable indifference to wild recklessness on the part of banks and financial institutions, those ideological factors have changed. The idea that markets self-regulate, I mean, sure, you can find people at the University of Chicago or the Hoover Institute or something. You can find people who will say that, but nobody really believes it anymore.
Thank you so much for this. I have a question regarding, because it's such a global system.
Yes.
And what really can you do as a regulator in a smaller, let's say, European country? Because obviously you're always going to have that effect
Right.
on you. So the fact that, you're the sort of, you know what to do and you structure your banks, that doesn't really, I feel like it doesn't really change the bigger effects that are
Yes.
happening. So it just kind of, what are your thoughts around that?
Well, that's an excellent question, and it enables me to pick up on something that I couldn't deal with in the time and space that I had. Small countries that were severely affected by the crisis did some rather radically different things. The country that actually did restructure, that had complete collapse of its banking system and did restructure its banks and did put people in jail, was Iceland. If you want to look at sort of the alternative model, I mean, Iceland's a little smaller than the United States, but or the United Kingdom, but Iceland did something radically different. And I think it is the view of people in Iceland that their society is a good deal healthier as a result, that they don't have the kind of fundamental political problems that some other places do. You'd have to talk to somebody in Iceland, though. I don't represent myself as an expert. I believe that's the case. Ireland did something worse, and I'm afraid that I did not prepare to go through what happened in Ireland, but essentially the banks got rescued and the Irish got very badly squeezed. All right? And that had consequences too. Right? I think you can date the rise of Sinn Féin as a political force in the Republic of Ireland from total oblivion to those decisions. And probably justifiably. All right, so what could a regulator do in a small country? I think the key thing, I think there's an embedded answer in this. Right? The global markets that we've been talking about are particularly short-term funding markets. Right? Making sure that your banking system is not overly dependent on short-term funding markets is a really good idea. Right? And trying to keep your banking system as much as you can away from global capital markets, right? So that essentially, if you want to do leveraged stock market investing, well, there's plenty of people in this world who will lend you money, but maybe not at home, right? Maybe you want to go someplace else. Trying to keep your banking system focused on operating businesses, housing, to the extent education is in the financial system, education, that sort of thing, is likely to lead to having a more stable banking system and a more productive and stable economy. But this leads to another issue that I want to raise and make sure you hear. This is in some substantial part the story of the radical financialization of the housing market. Now, the housing market's always been a private market, and it's always been kind of privately funded everywhere. Although not always. I mean, think about council housing in the United Kingdom and the portion of UK housing that was council housing at one time. Or you think about the role of Fannie Mae and Freddie Mac as quasi-public institutions before they were privatized. There's a whole set of basic human needs that in some societies at some times have been provided for by public institutions, sometimes in some circumstances have been provided for by private institutions, and sometimes through markets. And these are policy choices as to exactly how you're going to do it. Healthcare, housing, education, retirement security. They can be private or public. They can be degrees of financialization. The more these very, very basic things are put into unregulated financial markets, the more you risk some kind of catastrophe. Potentially a human catastrophe, a political catastrophe, or in the case of housing, a financial catastrophe. And I think That's not exactly financial regulation, but it's a larger policy framework to think about. We have any more online?
Okay, so we have some more questions that came in online. The first question comes from an anonymous attendee. What was the role of institutional investors, asset owners, asset managers in the financial crisis? And the second question is, in the mentions of the real economy, what types of things was the economy prioritizing, and how did it exacerbate problems? How is it continuing into the present day? In my understanding, we just had a dot-com bubble, which eventually birthed some of the largest companies in the US. So that's the second question.
Okay. All right, first question was institutional investors. Institutional investors were sort of at the heart of this, but they were not primary actors, except to the extent that already by this time you're seeing a drift by institutional investors into relatively short-term strategies that did things like produce some of the pressure on Fannie Mae and Freddie Mac to increase their earnings, which got them into subprime. Right? So you had institutional investors creating pressures. Institutional investors were very badly hurt by the financial crisis, by the fall in the value of equities, by the losses in their bond portfolios, by losses in subprime mortgages themselves. One of the striking things about the financial crisis was despite really decades of increased institutional investor activism around corporate governance, the failure of that activism to identify and deal with the grotesque problems that developed in the financial sector during the run-up to the crisis. I think the crisis caused some people to question the ability of institutional investors to effectively police markets, which goes back to this question of can markets police themselves, right? Because there's kind of two theories of how markets can police themselves. One theory is markets are sort of anonymous and perfect. And the other theory is, well, you get some really smart people and some big, powerful institutions, and they will look after things. This whole story kind of caused some doubt there. But fundamentally, institutional investors, particularly pension funds, were the victims of this story as much as anything. And they weren't really the drivers, in my opinion. They didn't create the subprime market. They didn't demand that it be unregulated. They got fooled, which is a tough story. Now, the second question, remind me.
So with regard to the second question, they're interested in understanding what types of things was the economy prioritizing, how did it exacerbate problems, and how is it continuing into the present day? And specifically, one of the things that they bring up is the student loan debt parallels to what happened around the mortgage lending crisis.
Let me just say one other thing about institutional investors first before I move on to that. This really highlighted, the financial crisis highlighted the extent to which institutional investors are universal owners. That the fate of pension funds and big money managers, the fate of their portfolios is not really determined in the end by like how smart they are. It's determined by whether or not they're functioning in a stable, growing economy. You couldn't escape this event. It didn't matter what you did. I mean, except for the Big Short, right? If you were smart enough to do the Big Short, to short housing during the bubble, well, that's different, right? But no institutional investor did anything like that. It really focused the minds of institutional investors on the question of regulation, economic and financial stability in a pretty profound way during this period. In terms of what does the economy prioritize? I was talking about that a moment ago in terms of what do we financialize and what do we not financialize, right? The United States didn't used to financialize the financing of higher education. It was largely done through government grants and government programs, the GI Bill, various kinds of student grant and student loan programs run by the United States government. It then got financialized in my lifetime, predominantly since I was in university in the 80s and 90s and 2000s. And as a result, you now have problems that seem sort of like subprime in student loans, but there's a lesson in it. Housing is gigantic. If you mess up housing finance in the scale that this story is about, you've destroyed your entire financial system. You can have deeply dysfunctional things happen in student loans, and it's bad for your society, bad for the students, bad for your culture, but it actually is not big enough to destroy your financial system. Housing can destroy a financial system. Right? And this also relates to tech and the tech bubble of 2000 and Enron and WorldCom. Fascinating thing. The corruption, the criminality, the fraud, and the collapses of that period were as bad as the financial crisis of 2008. Enron was one of the biggest capitalists, the largest cap companies in the world, and it just vaporized, it just disappeared. But the credit markets were largely left untouched during that period. It turns out that you can have all kinds of problems in stock prices and stocks, and it can do a lot of damage to people who invest in stocks, it can hurt pension funds, it can cause a modest recession, but it doesn't threaten the whole foundations of your economy. Whereas if you mess up your debt markets and your banking system, right, you run the risk of Great Depression type scenarios, 30% shrinkages of GDP, which is the course we were on prior to the interventions in the fall of 2008.
And then if you have time for one last question. Sure. Do you think fintechs are regulated enough to prevent the next potential financial crisis? What are the new loopholes that may be emerging around big tech and AI that big techs may find to exploit?
That's a fantastic closing question. Absolutely not. Fintech is not regulated enough. Cryptocurrency is not regulated enough. And the threats and problems are exactly the ones that I began this talk with. Right? This is what I mean. Paul Volcker, he whom is no longer with us, said during this period, he said the only financial innovation that has occurred, the only real and beneficial financial innovation that has occurred since the Renaissance is the ATM. And what he meant by that was, we've seen all of this before. We've seen accounting fraud, we've seen insurance fraud, we've seen naked insurance policies, we've seen banks, we've seen stock bubbles. It's gone on over and over and over again. There's not really anything new under the sun in finance. But what there is elaborate excuses for not properly regulating things that have been around for centuries. When a fintech company takes in money from over here and makes loans over there, they're a bank. If somebody's not watching them and making sure they have adequate capital and that they don't have asymmetries in terms of the time, who they have to pay when, right? Then you're going to have a banking crisis. It's just going to be called a fintech crisis. The same thing with insurance. Derivatives were a way of doing things that people knew hundreds of years ago were dangerous and just gave them a new name. Fintech simply adds computers. Right? It doesn't matter. The fundamental principle of effective financial regulation is regulate what it is, not what they call it. Right? That was the principle that was supposed to be embedded in the Dodd-Frank Act, and to some significant degree is. Right? But there's always a new scam. There's always a new scam. And I'll leave you with this fact and then let you all go. The United States, a little known fact about the United States securities laws is that they have an exemption. They say if you're essentially selling an interest in a business, if you're selling an interest, whether it's a debt interest or an equity interest in a business, that's a security. And in fact, it's broader than a business. It's like this very broad term. Any activity, right? A financial interest in any activity that's being sold, being chopped up and sold, that's a security. Not necessarily public security, but that's a security. And then there's an exception. The exception is the currency of the United States. The currency of the United States is specifically exempted from the securities laws. And what does that tell you? It tells you that a currency is a security. because it's an interest in the collective activity of whomever is holding the currency. Absent the exemption, the currency of the United States would be a security. And that is precisely what I told the Securities and Exchange Commission 10 years ago about why they needed to regulate crypto as a security, because it was self-evidently one in the statute. Right? Looking at what things actually are is the heart of good financial regulation. And fintech, AI, crypto, none of it changes what things actually are. And with that, I really thank you all for your patience and attention and hope to see you on Tuesday.